The new year is a time to reflect on the past year's results and outcomes as traders. This is an opportunity to create new goals to both improve and excel during the new trading year. For those of you who did not enjoy the recent year as a trader, now is your chance to start fresh by shifting your mind and seeing the positives that lie ahead. That will include removing bad habits and seeking advice on how to look for what you want and how to learn what works best for you. For those who made improvements and excel, this is the chance to delve deeper into your trading and finally work on those bad habits that you know are keeping you back and fine-tune the good habits that have led to your success. Even if you're new to trading or a seasoned trader with decades of experience, it's important to make note of your goals and commit to them at the start of the year and for the duration of the year. This is because you'll know more and be better this time next year, so your trading plan will need to be adjusted as well. We take the time to update our trading plan every year, and so should you. Here's our list of advices on dominating upcoming trading years. Tip 1: Focus on one single trading strategy or chart pattern until you completely master it. Instead of focusing all your energy on number of trading strategies, dedicate all your efforts to studying and trading just one price action signal or pattern. When it comes to your trading system, you should learn it so well that you could do it with your eyes closed. Once you have that down, then and only then should you move on to mastering another. You must fight the temptation to chop and change trading strategies at all costs. Commit to this one single idea, focus religiously on it, and see it through. Tip 2: Reduce the time you spend trading, and increase the time you learn about trading. During my initial days as a trader, I spent 14 hours per day watching the screens of my computer or phone for trades, watching open trades, and entering and exiting trades at every opportunity. Neither I nor 95% of the traders watching this video have any control over their emotions whatsoever. Most traders spend the whole day and night staring at their trading screens or smartphone screens, like an addict watching the cards and dice on a casino table. Do not think for a moment that because you're smart or educated or have achieved success elsewhere in life that you can't become addicted to trading. It can happen to anyone. If you spend all of your free time watching the charts or watching your trades tick by tick, you will destroy your trading career and your trading account balance. It may surprise some of you to learn that we spend less than 1 hour per day reviewing the charts and pondering trades. There is nothing we can accomplish by watching markets or trades. We have no control over what the market is doing or will do. Trading can be boring. We suggest that you not enter market every day looking for something exciting to happen. It won't happen. Tip 3: Fix your personal confirmation bias about trades and the market in general. You might not know that you see the market differently based on two things. Either you are in a trade or looking for a trade. Many traders have this confirmation bias which they can't get rid of without practice and experience. They make errors because they are programmed to have a bias about everything that is happening or is about to happen. Example: if you buy gold today, you feel like it went up $20 and then you see that it's expected to go up even more tomorrow, then you will probably feel even more confident. Example: say that today you purchase stock or commodity only to see it lose $20 of its value. Unfortunately, when you hear that an important geopolitical event took place which was unfavorable for your trade, you realize that you may have just taken a pretty lousy investment. Now we want you to ask yourself now, did the trend in gold price go up or down, or news about the geopolitical event, have any effect on your original trade entry and the price action you were using to confirm it? Obviously, the answer is no, but 95% of traders will still develop a bias for these so-called confirming factors that are unfolding. This is a simple concept in theory, but it is almost impossible to achieve in practice, and it will take a lot of work. Whether making a trade entry or an exit or anything in between, you must do so with 100% neutrality, zero bias, and with no attachment. This means thinking and acting in an almost inhumane and robotic, unempathetic way. While financial markets are a game that we invented, it is necessary to understand the rules of the game and control your emotions before you are able to play it. Before you place your next trade or plan to enter the markets, don't listen to external forces like articles and social media, and don't search for information to reassure you or make you question your decisions. You're the only one who should make that decision. Tip 4: Be aware of and avoid recency bias. Those with recency bias believe that what is happening now or what has happened in the recent past will continue to happen. Investors and traders who see the market trending up for several years become convinced that this upward trend will continue for several more years. Human nature is to fall in love with what is happening now, believing it will continue to happen without considering other alternatives to our assumptions or even looking for contrarian evidence to support the view we hold. For example, a trader may have had a winning streak for several days, and every day that streak continued, they grew more confident until they began to act like their streak was invincible. As a result, the trader increases his risk to unreasonable levels, becomes too confident, and completely ignores his trading plan and predetermined rules. The trader who is influenced by recency bias behaves differently to the techniques that led to them their current success. He is overconfident, which ultimately results in a potential future success being a return to zero, or maybe even less. Every day is different, and every trade is unique. Stick to the techniques and strategies you have in place. Tip 5. Write out your big goals as affirmations and read them once every few days to yourself out loud. Old school affirmations teaches you how to live a successful life. When you want to change something or achieve something, take the time to write it down on paper as well as cue cards, and then read it to yourself every few days, or better yet, every single morning and evening. The process of setting positive goals with affirmations is more complex than just stating "I would like to become wealthy or successful." Here are a few affirmations to get you thinking about how these statements should look on paper. I will become a profitable trader by consistently managing my risk and managing my emotions. I am a professional trader. I must trade like a business. I do not know what trade setup will win or lose, therefore I must take every trade that matches my trading plan without question. You can specify goals that are forward-looking. Tip 6. Slow it all down. To experience the big moves and the big risk-reward trades, you really must hold your positions a little while longer, to the extent of feeling uncomfortable and stressed. You should avoid living in the hindsight of your trades, let them mature and bear fruit for you. Don't pick the fruit before it's ready, and do not panic when market moves against your trade for a little while. The market is so much slower than you imagine, so give it space to breathe and time to move. The other benefit of slowing down your trading is it prevents you from churning your account. It prevents you from trading during choppy whipsawing sideways price action and ultimately bleeding your account. Trading is less likely to lead to addiction. Few trades a month will accumulate over time to turn into a strong account and happy life. You may even go for days or weeks without trades happening, which is great as it means you're approaching the mindset of a pro trader. Tip 6. Don't miss trades. Traders are defined by how many big trades they miss in a year, not by how many big trades they make. Most of you will experience the deer in headlight syndrome, meaning you freeze in the face of a great trade setup or second guess yourself after analyzing a chart to death and finally convince yourself that you are out of a great trade. Many of these missed trades can turn into great winning trades, but you are not in the trade. Since the outcomes of each trade are randomly distributed over time, nobody can predict who will win and who will lose in advance. Take advantage of this statistical fact to build your confidence so that you can start taking more trades that match your trading plan conditions and keep exposing yourself to the edge you have identified and profit from it. If you constantly deviate from your plan and ignore trade setups, you will lose whatever edge you had in the market. Tip 7. Exit trades if they are near your target. Apart from not being able to enter trades at optimal points in the market cycle for no reason, traders report other challenges such as profit targets missed or winning trades turning into losers because profit target was missed. There are 3 possible solutions for this problem. Make sure you exit your trades a few pips before your planned profit target level every time. That way you're not stuck waiting for hours for the market to reach your exit level. If you pick a profit target in the future, try not to be so perfect and instead make it 10 pip less than the original level you identified to exit the trade. That way you might start seeing more profit target orders filled and completed as intended. If your risk-reward ratio is 3-to-1 or 2-to-1 in past, lower it to 1-to-1 or 1.5-1 for the next 20 trades to see if you can build up your confidence with winners. It's important to monitor how far your stocks go once you've left the trade, since this will provide insight into how much you can increase your potential target prices for your next round of trades. If you exit at a lower profit margin, this strategy isn't sustainable in the long term, but in the short term, it will allow you to increase your self-confidence and learn a lot, so it's worth doing. Tip 8. Avoid trading too many markets. One can open up to thousands of markets on a trade app, and all of these markets are at their fingertips. Some markets, however, may be better than others because of the liquidity or size of the stock, and this can alter your chances of success. The most liquid and widely followed markets, such as major FX, major stock indices, gold, and oil, etc., are where the professionals almost exclusively trade. And so should you. What makes you think that trading a relatively unknown currency is more profitable in the long run than trading the euro or dollar? We advise you to stay away from exotic markets. Simply remove them from your watch list. Tip 9. Recap and record what you did right or wrong in the previous year. Recap what you did well. As you look back on the year, it would have ups and downs, and there's always something positive to take out of it. Keep in mind the things you did right in your trading this year. Be sure to make notes of what you did right and praise yourself for them. Staying disciplined over the course of a full year is difficult. If you have remained disciplined in parts of your trading approach, make sure you try to stay that way in the new year. Recap what you did wrong. Which errors have you made in your trading over the last year, and how will you correct those in upcoming years? It took us a few years to fully understand what our colleague meant when he said, "Pay less attention to your losers and even lesser to your winners." This means that each moment in the market is unique, and that every time two trade setups appear to be the same, the result will be different, and trades that win or lose will be random over time. Traders typically fail from repeating the same mistakes and not learning from them. So you need to make a change before it's too late. Did you make emotionally based trading decisions to enter and exit trades based on fear and greed? Did you put too much at risk with each trade? Have you been constantly changing your trading strategy without abiding by the trading guidelines outlined in your trading plan for trade entries? If the answer to both these questions is yes, you need to change your mindset if you want to succeed in forex trading. To get on track with trading, it's all about willing to change. Most of the losses are due to mistakes that are caused by not controlling yourself and not adhering to your plan. Bonus tip: devise a plan to improve. The goal of trading is to progress forward, just as you should be progressing in life. Avoid trading mistakes that you can fix. Common errors include trading without a valid trade signal, risking more than you should be, entering and exiting trades out of fear or greed, and complete lack of emotional self-control. These mistakes are what cause traders to crash and burn. The only way to make money trading is to have a strategy, follow a trading plan, and have the will and mental fortitude to hold it through long enough to let your successful trades offset your losing trades. Don't go into next year the same way you did last year. This is the best time to go over what you did well and what you did poorly, and to take action to make next year a more successful one. Make decisions now if you would like to be at a profitable financial position a year from now. Conclusion. Throughout today's lesson, we hope to inspire you to begin analyzing what you did well and what you did wrong over this past year to set some goals and affirmations for the coming trading year. We are hoping this exercise will give you the motivation you need to get your trading on track. If you like this video, don't forget to subscribe our channel.